Hello and welcome to the SourceOne webinar series, Managing Third-Party Vendor Risk in the Banking Industry. Today, September 9th, SourceOne Director of Supplier Relationship Management, Brad Carlson, will take you through the ins and outs of the recent OCC CFPB bulletins surrounding third-party associations and help you discover new ways to manage supplier risk as well as protect your company and the consumers they service. At this time, I'm pleased to introduce to you Brad Carlson. Brad is the director of SourceOne's Supplier Relationship Management practice. Brad's primary focus is development of post-contract partnership and supplier management programs to help clients discover additional cost savings, process improvements, and customer experience benefits. He has helped many clients improve their SRM programs, providing mutual benefits for both the clients and their suppliers. Brad has significant experience not only as a supplier management expert, but also as a strategic sourcing manager, aiding clients through the development and improvements of their category plans and internal strategic sourcing processes. Before joining SourceOne, Brad spent 15 years in a range of operations such as sourcing, supplier management, and risk management roles at Barclays, Sovereign Santander, and Capital One. Brad holds a bachelor's degree from Bucknell University and an MBA from Penn State. At this time, I now present to you Brad Carlson.
Just a quick preview. The main message, really want to pique your interest and get you to think a little bit about how your bank, or non-bank in some cases, is managing third parties. But before I get into that, just a quick preview. I'm going to first talk a little bit about the very recent history around supplier risk management as it relates to banking, to talk about some very recent regulation from the CFPB and OCC, and a couple of examples there of where there's been some actions. I'm going to talk a little bit about what we're finding on how banks and non-banks are responding, and then again finally talk about the SRM program and how that could serve to benefit some of these challenges. So without further ado, let's talk about how do we get here. So obviously there's multiple regulations that have sort of touched on third-party risk over the years. I just want to touch on a few high-level ones. There's been a number that touch on third-party risk, but may have been centered around other aspects of risk, like information security, business continuity, those sorts of things was maybe the primary. But back in 2001, we had the OCC bulletin, which is one of the first to come out around third-party relationships. And as we kind of progressed down that, we had OTS came out with a couple in 2004. But then from 2007 to 2009, we obviously had the Great Recession. So a lot born out of that, a couple of different things. We had the U.S. Financial Crisis Inquiry Commission, which had a number of findings, but overall, really sort of stating that this overall crisis is avoidable. There are a number of breakdowns that happen, and part of this was to obviously strengthen what sort of the regulations would be and to give a little bit more teeth to some of the existing regulations. So we saw the advent of the CFPB coming out of that, the collapse of the OTS, and a little bit of strengthening in terms of the OCC. And so one of the big ones that came out was the CFPB bulletin, which I'll talk about in a minute, which gives banks and non-banks protocols for managing service providers. And the other one that came out was in October of just last year, the OCC bulletin, which gives banks and FSAs clear instructions on managing third-party relationships. And so today what we're seeing is banks have programs in place and are sort of tackling this in a variety of ways depending on their size. So let's talk a little bit about the CFPB bulletin that's come out. So again, formed as a result of the Dodd-Frank Act, specifically with a focus on fair treatment of customers by your key suppliers. One of the big tenets in the CFPB was verifying that service providers understood and could comply with all federal consumer financial laws. So that's obviously saying a lot. And in terms of the detail, not as much as provided in CFPB. It provides guidance for ensuring a review of all third-party vendor policies and even their training materials to confirm that they've got adequate supervision and specifically around those suppliers who are contacting your consumers directly. CFPB also gives guidance on developing contracts that clearly outline expectations and also potential repercussions, whether they be fines or other, with failure to follow those. And finally, CFPB talks about creating processes and ongoing monitoring practices to be sure that if there is a breach in compliance, to properly act, right? The bank is then kind of puts the onus back on to the bank to be sure they promptly act for any sort of service provider default. And so, with that all being said, there have been recent findings and actions taken by CFPB. The first one, and I'll just give one example here, is around First Investors. So I don't know if anybody is familiar with this, but First Investors is an indirect and indirect auto lending industry, focusing specifically around subprime. And through investigation, it was found that this is fairly hot off the press in October of this year, August of this year, found that First Investors provided inaccurate information to the credit reporting agencies, and this had been going on for at least 3 years. The problem was discovered in 2011, April 2011. The evidence showed, that First Investors provided that they notified the supplier, but then didn't really follow up on it, didn't act on it, didn't make sure that any sort of the findings that they had in their investigation were remedied. So these inaccurate reports were going across, and the kind of information that was there was, distorted dates in terms of payments, inflated delinquencies, wrong payment amounts and overdue amounts, mischaracterization of the vehicle surrender. So as a result, there's a $2.75 million fine. So I sort of bring this up just to kind of highlight the fact that this kind of activity is beginning to increase. So the next one, just to highlight a bit, is OTC, which outlines key stages within the risk management or supplier life cycle, rather, that all banks should be undertaking, and goes into a little bit more detail than the CFPB did. And really, this arose because during previous investigations, they sort of saw a failure to understand risk and cost of third-party relationships. There was failure to assess third-party supplier risk management policies before getting into contracts. There seemed to be a lack of ongoing monitoring activities, failing to enter into formal contracts in some cases with third-party suppliers. And so they created 8 stages in terms of what they expect banks to follow from a supplier lifecycle management perspective. So we've got planning, right? Create the plan. How are you going to manage that third-party relationship from beginning to end, understanding the risks that happen beforehand. The second one is selection. So above and beyond a traditional RFP and cost analysis, looking for some thorough research behind third parties before hiring to make sure that the level of activity, level of due diligence matches the kind of risk that you're undertaking. So, obviously, when you've got suppliers that are going to be touching your customer, a significant level of due diligence called for there as compared to others. Negotiation, ensuring that the contract is clear in terms of responsibilities for each party, and in many cases, it's looking for evidence of board approval when third party is contracted to manage when it's a critical activity for the bank. The fourth one is monitoring. So monitoring the third-party relationship throughout the life cycle. So that's what sort of activities they're doing, how are they performing those activities, are service level agreements being met, are key performance indicators being monitored and met. Termination, so a transition plan, right, or a disaster recovery plan as well, to be sure that, you know, once a supplier is deemed, you know, unable to, you know, the bank is looking to move on from the supplier, that there is a way that those activities that the supplier is supporting would be maintained, you know, through that transition plan. Accountability, specific designated roles and responsibilities for the third party, ensuring that the board of directors is involved in the effective management of that supplier as well. Again, particularly where there's critical activities that are being performed. Reporting, documenting the processes and other details regarding the third party's responsibilities, again, throughout the entire contract life cycle. So that gets into the governance aspect of things. And finally, reviewing. Independent reviews of all of third parties to be sure that they're aligned with bank strategy and risk management practices. And one of the things that I'll highlight here is the monitoring and reviewing. I think a lot of folks have sort of aren't they kind of the same thing. But the view here is that no, they're not, because the review, you know, you're looking really for more of that third party, which, you know, hiring an independent audit once a year is a lot different than that day-to-day monitoring or month-to-month monitoring or week-to-week monitoring of key performance indicators and service level agreements. So even with that, you know, I've talked before about finding around the CFPB. We're finding the same with respect to OCC as well. So there have been a number of these kinds of findings in the news around credit cards, around UDAP, but I want to highlight this one in particular here, where JP Morgan was ordered to refund customers in the amount of $309 million and pay an $80 million fine as a result of their cross-sell activities. And this is one where both the OCC and the CFPB issued separate but related consent orders with JP Morgan for really the marketing and sale of identity theft protection and fraud protection between 2005 and 2012. Essentially, what happened here was very, very simply, the bank and its third party were charging customers for products, but before having proper written authorization to perform the services. So very simple and straightforward sort of regulation, right? If you're going to sell identity theft or fraud protection, then you've got to follow the proper procedures and have proper documentation. In this case, it was both JP Morgan or Chase Credit Card in this case, who was sort of at fault. However, had been working with partners selling these products, and because they did not perform that proper monitoring, they didn't do that proper due diligence, they couldn't provide the evidence, for a number of years, obviously, that this fine was levied. So, with that all being said, what is actually being done? So, what is our findings in terms of what banks are doing? A couple of things. So one, internal programs are being built, but often what we're finding is that they tend to stop at due diligence or simply producing, a report of a third-party supplier. Many times we're finding that very siloed, or either sort of saying nobody's got that holistic end-to-end view of the supplier. The sourcing department may have one view. The risk department may have another view. The compliance group may have another view. Legal may have another view. In addition, we're sort of finding we've contracted that risk away with the supplier, and so we don't need to do that monitoring, right? It's sort of not our responsibility. from the business unit. But obviously from those two previous examples, we know that that's not the case. We're also finding where banks are going to law professionals in the field to help with contract due diligence, but that sort of stops at the contracting and due diligence aspect, which obviously does a lot to mitigate risk, but doesn't necessarily help in those other aspects of the OCC bulletin where it talks about reporting and monitoring. And so what we're beginning to see is other banks have built supplier relationship management programs, which, what I mean by that is sort of the end-to-end management of the supplier's activity within your firm or bank. Typically, there's someone designated to have supplier management as one of their major objectives, or perhaps it's one of their sole objective, right? Many times we've seen where it's been a specific department, a supplier management department, or sometimes it's within the sourcing group. Other times it may be within the compliance group, or other times you may have a specific or third-party risk group. Or, depending, it's cascaded out to the business as well. Whereas, the compliance group or the sourcing group sort of run it as sort of a governance function, and the responsibility then sort of remains out in the field, out with the business, in order to manage the supplier on a day-to-day basis and be providing data for reports and that sort of thing. So to talk a little bit more about supplier relationship management and what it means. So SRM can be built for a multitude of reasons to sort of help with a business case. Companies outside of banking have instituted these sorts of programs for many years with a variety of benefits. And I'll just go through a couple of examples here. Increased efficiency. So when problems arise, having established SRM processes and programs in place enable both partners to quickly identify and address them. Suppliers can anticipate and adapt to the business needs quickly, and the idea there, eliminating redundancy and streamlining processes. Cost savings, rather than sort of needing to benchmark different industries where the suppliers work, buyers can, or the bank or whatever the buying firm is, can depend on their preferred suppliers to share new trends in the market, be able to provide, sort of best pricing, revenue growth as you've got increased customer activity correlated with greater revenue, and for both the business and for the supplier, then you're, both are winning in that case. In terms of innovative thinking, there have been businesses out there who, by becoming customer of choice, right? So looking at supplier relationship management from a customer of choice perspective, buyer of choice, open communications at all levels is extremely important and can spark new ideas and elevate organizational sort of discussions that lead to a better focus between both firms, which then could potentially result in benefits for both. Preferred buyer status. So all of these very much relate to being a preferred buyer, having that kind of relationship and having those processes in place within your firm. And just as a supplier has got a customer relationship management view of you, the idea here is that you've got a similar view of your suppliers too. Finally, risk management, right? So there obviously have been major risk management benefits in terms of developing such a program. So incorporating a risk control self-assessment might be part of this. In many cases, risk and incident logs with your suppliers, which can then kind of feed into your existing loss data collection activities. It could feed into your existing information security program, your disaster recovery program. But more importantly, the control testing is another aspect of risk management that's typically incorporated here with your suppliers. So doing control testing outside your four walls can help to identify potential breakdowns and events before they happen. So again, that establishing sort of that kind of monitoring program, along with what the OCC is looking for, an SRM program is looking out for those same exact sort of things. And real quickly, I'll just kind of walk through what we are viewing as sort of the model in terms of developing and building an SRM program. So it's, for one, the process of developing and building such an SRM program is quite cyclical in nature, right? You'll start at the top and look at best practices, so conducting a best practices assessment. We'll look at policy development and doing a gap analysis between what are best practices and what present policy is providing or suggesting. As a result, you begin into business case development, defining roles, responsibilities, defining governance structure, defining some tools where what is it that you're expecting your supplier managers to do on a regular basis. And lots of times what we're seeing is just a variety of activities here, quite customizable in this space, not an off-the-shelf kind of a situation, right? It just really depends on what results from that best practices and the policy and gap analysis. The next thing we're finding is that's extremely helpful in these programs is a segmentation calculator. So really the development and rollout based on, how do we rank or segment our suppliers based on strategic importance, regulatory risk or regulatory obligations, customer contact or customer impact, disaster recovery impact, information security, and other sorts of obligations. This can then feed into your contracting process. It can feed back into your existing risk management and control process, and really across the board helps multiple departments do their job. The next sort of stop or review in this process is the supplier risk program. So how do we identify operational compliance risks that exist with suppliers, looking at controls that mitigate those risks, and then, as I talked about before, a testing program of those controls to determine different effectiveness and thus the residual risk. These supplier management tools then that we talked about before, based on the segmentation and your risk program, then help determine which tools you actually use or which ones you don't use, or how do you further develop your tools to work better. Next stop along here is the training, right? So in many cases, what we're seeing is, from a supplier management standpoint, you want to make sure that folks have a focus on supplier management, so giving them the right tools and training if necessary. So if you've done your best practices assessment, you've already figured out what your gaps are, you've created specific tools that you want to see implemented, you know what your supply base looks like, you know who is using your suppliers, you've segmented them. You understand, by coordinating with your risk department, what that risk really means. And then you want to be able to roll this out. So how do you roll it out, right? You've got to do a bit of training potentially if you are, expecting that folks out in the business are going to do this. You may need to bring in additional resources to help with that training. You may need to bring in additional resources to help establish and run the program. It's sort of a wide variety of tactics that we're seeing different firms take in this way. But really, it's the idea that once you've got your plan set, you need someone to execute. And then finally, execution. Resources, identifying different benefits then with your suppliers, right? So can you, as you're managing your suppliers on a regular day-to-day basis, how are they feeding into your risk program? Are you able to identify additional benefits beyond just the risk management? Are you able to identify duplication of purchases? Are you able to work on spec management so that you're not overbuying? Are you able to work with the supplier on process improvement? Are you able to work with the supplier on establishing, sort of a preferred buyer status for your bank. So a number of different things can happen within that execution bucket. So to wrap up my portion, I've given just a quick background history on why and how third-party risk management is evolving and changing. I've given you some insight into how some firms are handling these changes. Hopefully gotten to you consider and think about SRM and pique your interest a bit here as another potential approach in addition to your other activities to mitigate supplier risk and drive additional benefit. So now I'm really interested to get everyone else's thoughts.
Thank you, Brad. It seems as though there are no questions at this time. Should any questions arise, please don't hesitate to contact Brad by the contact information found on the screen. Thank you for watching. Visit sourceoneinc.com to learn more about our services. And thank you again for your participation.